Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined as always by Brett Schaefer, the one and only. And we've got really nothing huge on the week. I've got something exciting. It's a small cap of the week that's, I think, probably the most interesting one I've looked at so far, most compelling. So I'm going to present that to Brett, see if I can maybe excite him a little bit and potentially do some deeper digging. We've also got Rivian news. I don't want to call it huge news, but it might actually be quite huge news for Rivian. So we're going to talk about that as well. And then I guess, Brett, any other news that you brought this week?
Well, we got some questions on Celsius. The energy drink company has gone into a bit of a downturn. I think it's because Starbucks has a new energy drink out there at its stores, which seems quite interesting as well. So maybe we could do a combo with those two. But I think that'll be fun. And we have some questions from Twitter X. That's really it. We'll hopefully get some questions from the audience. Maybe this could be a more philosophy focused episode. But for any housekeeping items, anyone listening, we just dropped a Nick Sleep Nomad Investment Partnership podcast as we're recording this today, but last Wednesday in your podcast feed. Go check that out. We're recording one on Molson Coors yesterday as we're recording this. So exciting stuff.
Yeah, and we were thinking about what investor should we do next. I got one for you, Brett. Peter
All right,
Lynch.
hit me. Who?
Peter Lynch.
Not
Thoughts?
bad. Okay, yeah, I've never actually studied him that much.
Neither have
Just
I.
kind of the quotes that get thrown around online.
Peter Lynch. All right, so maybe we take that one for the next month. But before we get into things, we want to talk about our friends, as always, Public. Are you paying too much to trade options? If you're not trading on public.com, then the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded only at public.com. This is paid for by Public. Investing options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. Where do you want to start, Brett? I'll tell you what, maybe small cap of the week, or should we wait for people to trickle into the YouTube live stream here before we do the most exciting part?
Yeah, let's say I think it's good when we save that for the end because it's good when we get people asking some questions on that, and you almost get the hive mind researching at once, which is quite fun. But maybe let's hit Rivian. I think that is the biggest thing that happened this week. Stocks up 30% today. Maybe we can do a little 10-minute segment on that.
Sure. So I guess the news here, Rivian Automotive, the EV, EV pickup maker. Is it a pickup truck, basically? EV truck maker. I think there's an SUV as well. That was at one point sort of a market darling, has suffered a bit as of late. And Brett, actually, if you can pull up maybe a screen share here to demonstrate the cash balance, the short-term investments plus the cash, so that we can get an idea of.
Yep, I will in about a minute here, tweeting out the link. But yeah, I'll get right on that after.
Okay, so the news here is that Volkswagen is going to be investing up to $5 billion into the EV maker Rivian. It's structured a little funny. So it's structured sort of as a joint venture. The line from the Wall Street Journal here is Volkswagen Group is investing $1 billion into electric pickup maker Rivian Automotive, with plans to spend up to $5 billion as part of a software development partnership. So it's kind of this, I think they're trying to use Rivian to help kind of bolster Volkswagen's software offering, in-car software. So it makes you kind of think, it almost feels like this Lifeline for Rivian is almost gambling for Volkswagen. Like, I think it feels like Volkswagen's kind of the savior here. I don't know if I see necessarily the upside as much from Volkswagen's perspective. And I'm not exactly sure how this joint venture works out, or whether it's like an outright investment, how it ultimately, like what the financial incentives are here. But if you look at Rivian's financials, cash and cash equivalents, and if you go to quarterly, Brett, we can kind of see a better visual here, has dropped from $18 billion in cash and short-term investments to a little over $7 billion, I believe, and as of the latest quarter. So it's been burning cash pretty quickly. And if you add the free cash flow on there, they burned, I think, through around $6 billion in free cash flow over the last 12 months. So this was cash that was really needed, especially if they get all 5 billion of it. You're looking at really a major lifeline. And I think the CEO of Rivian actually went on in an interview and basically said, like, look, this gives us the funds we need to actually get to cash flow positive at some point. And without this, it probably would have been pretty difficult. And it looked like, from the outside looking in, looked like this was a business that was going to struggle to produce vehicles profitably in the future. And especially with Rivian having plans for a low cost model or a lower cost model that's coming out soon, I think this is cash that was very much needed. I guess, what are your thoughts here, Brett? Why do you think Volkswagen did this?
Well, according to, I think it was the Wall Street Journal article, they said that they're having trouble with any sort of software stuff in the whatchamacallit, EV space, and the infotainment systems, the car stuff that Tesla's famous for, the Chinese companies are famous for, being much, much superior to the legacy brands. They just really couldn't nail that. I don't know how complicated it is, but maybe it is very complicated. So that could help. Um, but I don't know why Volkswagen would do this, except, maybe the terms feel attractive to them. And Rivian does have a good brand. I mean, people love the cars. You can see the reviews. They think they're fantastic. You see them replacing a lot of the upper whatever Tesla Model X and S, the higher end ones, at least where I live. And I think that's all throughout the West Coast of the United States. And then Rivian, they're burning a lot of cash and they need to get to a higher scale in order to hit positive cash flow, just because with the vertically, they're manufacturing their own vehicles. So they're not doing any sort of partnership with an existing factory. They built it all themselves. So they need to hit some sort of scale. I think they're only doing about 15,000 deliveries a quarter. I mean, you need to get much, much higher, and that's going to take multiple years here. So it makes sense for them if they can reduce the cash burn to maybe, if you saw on the chart there, have gone a little bit better over the last few quarters to about 5.5 billion versus 6.5 billion in cash burn. If they can get that down to, 2 billion or something like that, as they try to get bigger and bigger and bigger, I think the markets will appreciate that, and they'll understand that there's a path to profitability, and they'll give them, you know, room to raise more money and try to eventually get to scale. Because if they can be one of the second scaled EV player along with Tesla, there could be some benefit there, especially at this low valuation. I would say though, a lot of people, and this is a lesson on, sorry, my light gets way too, I don't know why it does that. For anyone listening on YouTube, I can never figure out how to fix that. It just kind of comes and goes. The light is actually not changing, but that's besides the point. If we look at what was I trying to say here? The investors that look at Rivian, you have essentially a market cap of before today like $10 billion, and I think it's a lesson in saying, look, given the balance sheet, and you have to really look at the balance sheet before looking at something, you probably should have priced in something like what happened yesterday, where there might be 100%, 200% dilution, and that could be okay if you're gonna get the growth along with that. But that's something you need to price into your valuation work. You can't just say, "Oh, well, they have this number of shares outstanding. The enterprise value is actually lower than the market cap." Well, I wouldn't include that because the cash is going to get eaten up almost entirely, and we have a market cap of $10 billion. Well, the stock looks kind of cheap if they can scale. Well, no, you got to price in that cash burn and the potential equity dilution. It's just all part of the valuation process.
Yeah, I think people consistently underrate the complexity involved in building a successful automotive business, like a profitable automotive business at scale. Like, Tesla would not have been able to do it had it not been for the investor buy-in. Frankly, like the cash they were able to raise really gave them the runway. And pretty much every EV maker that we looked at, I remember, or any automotive company that started as of late, they expected cash flow a little sooner than it came. And there's just it's almost like the airline business in a way, where there's just always costs you don't expect coming due in the next quarter, and inventory becomes an issue. And then the other part is interest rates probably don't help. It probably doesn't help people finance cars, so it makes it even more difficult. Yeah, I think they would have had basically a year, maybe a little over a year of burn rate at this point. So this is cash they certainly needed. The CEO seems to think they can get to cash flow positive with this new cash infusion, so certainly helps. The other thing that was interesting is there's been that inventory buildup on the balance sheet. I was kind of sharing my screen there. Maybe that can kind of help with cash flow if they're able to sell through some of that. But at the same time, it's maybe concerning that they haven't, that inventory continues to grow when they should be selling cars kind of at will now. So I don't know. I guess there's some concerns. I will say anecdotally, a lot of Rivians on the road here in the Pacific Northwest.
Yeah, there are, but I do agree that you got to look at, if you look at that anecdotes, you could say, oh, okay, a lot of the wealthier people out there are buying these Rivians. They're very expensive. They probably have good unit economics. I will say, I think their costs are still extremely high. So I think they're giving quite the consumer surplus on these vehicles, which is going to make the customers happy, but eventually you got to make money. But the thing you mentioned there about the inventory buildup is, yes, they're still at such a small scale on their deliveries number. They're not even close to the scale you need, about of 1 million cars a year, maybe, or maybe for them as a more premium car maker of 500,000, 400,000, 300,000, something like that. They're so far away from that would concern me. Like, okay, you're already hitting a deliveries wall and you need to kind of innovate and lower prices here or come out with new models. That's kind of troubling, wouldn't you say? I think that's the number one concern I would have with this company. But given how much people appreciate the cars, and given we shouldn't forget that 100,000 vehicle Amazon partnership for the commercial van side of the business, I think
Did that not
after
get
this
scrapped?
capital raise, it makes me more. Obviously, the stock went up 50%, so it was a good thing. It makes me a little more bullish on the company.
I thought there was some sort of falling out between Rivian and Amazon, whether it was
No,
like
I
they
don't think
sold their
so.
equity stake or something with the contract. But I guess you've been following it closer. So yeah, I don't know. I don't think I'll ever touch Rivian. I don't know if I'll ever own a car company in general,
Yeah,
frankly. It's just a business I don't really want to be a part of.
I like airlines more than cars, to be honest.
And I don't like airlines.
Yeah, exactly. That's a low bar to hit. Got some questions in here if we want to flip to another topic. Someone asked on Nick's Sleep, do you think Nick Sleep would have switched away from Deep Value if his AUM hadn't gotten larger? I.e., was the switch made because Deep Value doesn't scale as well? I will say that we had some thoughts on this during the interview, and we'll have more fleshed out thoughts. Maybe it's a little tease here. I'll answer this. Our thoughts reading the letters was that he really skated to where the puck was going, where the opportunity set in the year 2000, 2001, 2002, 2003 was phenomenal for Deep Value across the world. But as we approach the great financial crisis period, the compounders, as you might call them, the Costcos, the Amazons of the world, were maybe the most attractive part of the market. And that's, I think, what happened.
There may have been some frustration around. He expressed in several of his letters frustration around not being able to buy securities that were so thinly traded. So maybe that was part of it. The other thing is, I think with some of these, the performance wasn't really what he expected. I remember him being pretty frustrated with the Zimbabwe investments that he made, especially in some of the international markets, like just not materializing, or the people running the company did not think the same way as him.
Well, Zimbabwe also went through hyperinflation and had a terrible dictator, so a little unlucky there. But also, that's what happens when you invest in the most emerging markets.
Yeah, I mean, I like the idea of looking anywhere, but I think if it's a market you're really not familiar with, I would maybe just be wary, extra cautious. And I think there are some markets for me where if you quoted ridiculously cheap multiple, I'm probably just going to say no, no matter what. And I remember I can't remember what it was, but there was some company that he tried to invest in, and it was like, he had to email them. He's like, can I get or maybe it was a written letter. He's like, can I get an annual report? And they're like, no, annual reports are only for our shareholders. He's like, well, how do I know whether or not I want to become a shareholder? And they just like responded like, yeah, that's a common complaint. It's
Yeah,
like, when you deal in small caps, like that's sometimes the issues you're gonna get.
yeah, and I think that's fixed now because of Edgar and all those online platforms because they had to file the 10K there if they filed it, and it has to be publicly available. So luckily, the SEC has helped with that. But yeah, we have a full episode on them, so nothing on them. We'll talk about something else. We have a comment here. Did you hear about Ferrari starting a 7,000 euro subscription for servicing their electric vehicles that includes a battery replacement after 8 years? Oh, that's interesting. Yeah, man, Ferrari is supposed to have that super high quality customer service. And I think that makes sense. This reminds me of, well, I guess it's a little bit different, but they do have the same philosophy in general. There was a huge long form article in the Wall Street Journal, I believe, about Hermes and how people, yeah, I mean, there's almost some regulatory stuff happening where people they have this under, I don't want to say under the radar. No, that's the wrong term. It's a undiscussed thing, but it's something kind of an unwritten rule of the shopping experience where you have to buy a bunch of other items before you get offered the ability to buy one of their top Birkin bags. And I think the same thing can apply to Ferrari, even as they switch to electric vehicles, where you have to buy one of these, then you get the top model, then you get this, you have to buy the subscription service for the battery replacement. And it just keeps that club like feel of the business going. And it almost feels like, oh, yeah, like it's, you have to think about it where someone has their Ferrari. And the point not necessarily is to have it and to drive it. It's also to brag about the service and how you're a part of the club. And like you can say, oh yeah, like they do all the battery replacement for you. That's not an issue for me. You can talk to your friends and stuff like that. That's part of the moat and that's part of the quality, the service they're trying to provide. Make you feel prestigious versus everyone else.
Yeah, and I think with Ferrari specifically, they're of course, wanting to be a part of the club, wanting to be able to brag about your car, drive it around, all that stuff. That's part of what drives this powerful model where they can charge exorbitant prices. But the other part is they really do take good care of their customers. They're renewing customers or the customers that have been around. They get first dibs on a lot of offerings. They get treated like they really are a member of this Ferrari club. I think it was a quote from the Rolls-Royce CEO a long time ago where he's like, the greatest investment I can make is going and taking very good care of my existing customers. And I remember like if someone's Rolls-Royce broke down, he would fly out or he'd have a team fly out there, go take care of it. And it's like, I think an analyst or something asked, like, aren't you losing tons of money on that? And it's like, there's no better service. Like they will tell their friends, which is the best, most powerful marketing about it. And it pays dividends in the long run. The other thing is, this kind of takes me into a different tangent, but my personal opinion is that customer support, good, real customer support will become a competitive advantage over the next 10 years, especially as a lot of companies are shifting towards AI powered customer support that is not able to really help a lot of questions or even
Hey,
edge cases. Um,
I think if we spend $100 billion more on capex, we'll get there.
I just think a lot of companies neglect that aspect of running the business, and having someone who can really handhold, like a customer support agent who can really handhold customers in the process, like that serves you really well in terms of word of mouth marketing.
Yeah, let me give you an example here. I have two separate bank slash credit card accounts, Bank of America and American Express. Bank of America uses their AI chatbot. They call it something like Erica. It's useless and it's really hard to get a real person. But American Express, you go to the customer chat thing right within the app. There's a real person, usually within 5 minutes. So uh, that's nice. I mean, it really helps. Saves you time, saves you money.
Yeah.
All right. You want to talk Celsius? We already had a comment in here. Maybe this will kick things off from a guy named Michael. Welcome in, Michael. Says Nielsen data says year-over-year decline, market share down, but still growing. Its energy market is growing. So I guess market share year-over-year down. Company telegraphed for 2 quarters because Pepsi was adjusting distribution, which said would hurt in the short run. Ryan, what do you want to start off with Celsius here? Maybe we do this as one of our FinChat ones. I can kind of share the screen here and start her up.
I can
What are your
share.
thoughts?
I can share here.
Okay, you
The
got it?
yeah,
Yeah.
let me share and just kind of give the total drawdown. So down 42% off its most recent highs.
Volatile stock. This is volatile. That's just
Yeah,
5
for
years. How
sure.
many drawdowns have we had? 3 years, we've had 60, a 30, a 30, a 30, a 30, and a 42. That's crazy. That is wild.
Yeah. So the I think there's been a lot of stuff with Celsius. Like there was a lot of bad news. The year over sorry, the growth trends, and this is a huge like alt data investment. This is one where people are constantly tracking like the alternative data, and so you'll get stock moves constantly with that. The other part is there was the guy that died, like, or I think he died like drinking like 2 Celsius a day, which or maybe that's on him, but it just wasn't a great news story that came out right at the same time. There was a little bit of negative commentary out of one of the investment conferences. I can't remember exactly what the executive said. And then, yeah, I guess you mentioned that Starbucks has recently launched this new program or this new energy drink. So I think a lot of things are hitting them at once. The other part here is that they trade very expensively, and I think that's one of the difficulties is that when you have a business with a high multiple, little things, little news stories can have a huge impact on the stock price. Because
Yeah, and if
when
you
it's
stop, I have their price to gross profit. If you want to stop sharing, I can share a chart on
sure
that.
thing. Yeah, it's when you're priced for perfection, it's you got to be perfect or else shareholders are going to have a tough time.
I agree. I agree. Yeah, if we look at the shared screen here, price to gross profit has fallen to about right under 20, say about 19. And a couple years ago, we were at 90. Earlier this year, we were close to 40, 35, I guess. So, yeah, that's all there is to it. And a price to gross profit of 19 is still not cheap. Obviously, if they double revenue again, that would make it a little bit more inexpensive. But what are your thoughts on the stock here, Ryan? I guess we don't follow it too closely, but if we look at the long term, let's just look at the gross profit growth. I mean, it's been great, you know, especially the last 3 years. Let's even go annual. It's more impressive. It's just skyrocketed. But if we look at maybe, let's do the last few years and maybe do quarterly. Have we slowed down a bit? I mean, not really. Still at 95% growth. And I think the problem was people were pricing in high double digit growth for a long time. And it might just be this growth is going to slow down now. And that's what's happening. Look,
Yeah,
one thing that I guess, sorry, I'll let you talk in 1 second. When they were at 3% market share and you could kind of see it kept taking fire and maybe it was popular in certain parts of the country, you could say, okay, there's a pretty reasonable way for this to get to 10% market share. There's only 2 major players in this industry. Companies like Rockstar and Bang Energy are ceding share. So there's a lot of open space to go after, and it's a growing market. But when you're at a 10% market share with two incumbents like Red Bull and Monster that dominate shelf space, I think that's going to make it harder for them to gain market share for here. But I wouldn't be surprised if they hit 20% in the United States. And then the second thing is they've struggled a lot internationally. So that's a much harder, you have to see the momentum they're starting. I'm not sure TBD on whether they can be successful internationally as they have been in the United States.
Yeah, Celsius, it's one of those that's really hard for me to judge. It's kind of like it's kind of a crapshoot in terms of where I think market share ends up for a company like this. Like how many people switch off of Red Bull, switch off of Monster, and move towards Celsius? How much of it is new consumers altogether? How long can they sustain the growth rates that they've had over the last several years? Probably not very long. So it's I think it's one of those things where I just have a really hard time judging the opportunity, especially when it trades at a premium multiple. And it's kind of the same with retail in a way, where if something's really hot for a while, I kind of have a hard time figuring out whether or not that's going to last, like a Aritzia or a what's been popular lately, Hoka's, something like that, where it's like a brand and it's
Aloe.
culturally like taking off, but you just like I have no sense of the longevity, no sense of whether in 10 years people are still going to be like a huge chunk of people, like call it 2 or 3 times today's current consumer base, are going to be drinking Celsius. You basically have to believe that's going to be the case if you're going to invest in the stock from here. So, or you have to believe that there's lots of pricing power. I think the pricing power is there, but
Well, food and drink is better than apparel. That's
yeah,
for sure. But I think what Ryan's saying there is he wouldn't be opposed to buying a stock like this, but you have to consider that when weighing your probabilities, how that impacts the price you're willing to pay.
it also okay. So there's the distribution advantage. That's real, but it energy drinks feel a little bit lately like um, the vapes industry, where a lot of companies are starting or building some sort of energy drink brand. We're seeing it with Coca-Cola. They're building all those coffee / Coca-Cola cans. We've seen it. There's a whole bunch of upstarts of just energy drink upstarts, and it seems like it's easier to produce one of these than maybe it has been previously. And obviously the distribution advantage that's real, that's significant, and it leads to better unit economics. But I don't know, I just worry that it's going to be ultra competitive, and I think that's why you see big brands starting to get into this is they've seen the returns on capital that Celsius can generate, and it's the capital returns theory. Just it's excited every big brand, and now they feel like they want to be a part of it.
Yeah, it's definitely going to be a moat test. I would probably take the other side of that and say that if now Celsius is earlier, but maybe call them the big three along with Monster and Red Bull. I would bet that those are still the dominant players 5 years from now in the United States. I mean, Red Bull and Monster have been around for a long time. There's been a lot of people that have tried to attack their market, and they've been able to successfully, you know, retain their market share within the space, and the space is growing. So they're growing overall share of the just food and drink space. So
Yeah,
I
Michael.
I, I I don't know. Look, there's those ones from all these influencers like Prime that grew fast. It's almost like Feastables where there's a huge burst, and then I've seen some of the market shares. It's again, these are screenshots from tweets, but the market share of that is apparently just fallen off a cliff. And Celsius, it's not as again, it hasn't been near long around as nearly as long as Red Bull or Monster, but I'd say that they could definitely retain their market share. But given the price we're at today, it's not about retaining market share in the United States. It's about growing market share and succeeding internationally.
Yeah, Michael says energy drinks is like the ready to drink coffee / frappuccino craze in grocery and convenience stores of 2005 to
No,
2009.
I don't think so. It's way more durable.
Yeah, well, it's been a secular growth category for what, 2 decades now.
Maybe 3.
I think there maybe I just haven't been paying attention, but it feels like there's a lot more options and alternatives today than there has been kind of if you look 10 years ago. I feel like it was primarily dominated by Monster and Red Bull. And now you go to an energy drink section in the grocery aisle and you kind of have unlimited options.
Yeah, I haven't followed Monster Energy this year though, but it seems like the business is still firing on all cylinders. So I
Yeah.
think it's not a big deal. Now I'm gonna read this Starbucks thing that I think kind of scared people a little bit. Maybe it wasn't. Maybe it was some alt data that people saw. I love talking about alt data because you never have to get anything proven until it actually happens. And a lot of the times, the earnings report is actually quite opposite of what you're seeing in that alt data. So, but here's what it says: Elevate the day, and this is from Starbucks' own news thing. Elevate the day with a boost of sugar-free energy with the new handcrafted Starbucks iced energy beverages. These drinks combine sparkling fruit flavors with iced tea for the ultimate jumpstart and are available at stores in the US year-round. The new Melon Burst iced energy features refreshing flavors of melon, tropical citrus, frozen tropical citrus, iced energy with strawberry puree, and then they have some cold brew stuff that was new as well. That's the thing about the sugar-free and the fruity stuff. That's going after Celsius a bit, and I think that's probably where people are scared.
Yeah, it makes sense from Starbucks perspective to do this. The one thing I'll say is that, you know, what was it, 15 years ago that they Starbucks also tried to become like a an alcoholic place to go past like 5 o'clock. Remember, they were like trying to get really big into wine, and it's just like they've tried to pivot a lot and try to add some of these different drinks. Maybe this is a little easier, but I don't know if it'll really steal that much share from Celsius. You see it all over. People are trying to copy Celsius. A lot of the typical or sort of the name brands in energy drinks,
Even Monster,
Monster,
yeah.
uh, Red Bull's kind of had the thin cans for a while, but they've gone after. They're trying to replicate the style of the product, try to make it seem healthier by having a. It's funny that just having a thin can makes people think it's a little bit healthier, but
Yeah, that's it is quite interesting how that stuff can work. And they talk about sugar free. They add the B vitamins, which people love. Oh, got to get all those B vitamins. There's like 12 of them. But we look at the stock today, Ryan. Clearly, we're both fairly bullish on the Celsius brand, and we think it's an interesting category, although not the best category in the world. What? God, this light today has been crazy. I might just turn it off, honestly. Um, what price? What? Let's say the earnings are a little bit lumpy just because they're still growing. What gross profit multiple are you buying Celsius today?
I don't really think I want to own Celsius.
Really?
Yeah. There's I don't know. It's one of those things where I've got no reason for it. It's just kind of a gut feel that I don't want to own it. And it has been professionalized, if you want to call it that, over the last 3 or 4 years. They used to have a lot of the accounting issues. There was a lot of, if I remember correctly, there was like executive problems going on too. And part of that was because they were turning from a small cap into a large cap in a matter of 2 or 3 years. So there's always going to be some issues, but I don't know. Something's keeping me away. I think I'm just a little wary about their market share within the energy category, and I think a lot of people are just forecasting growth in the energy drink category indefinitely here, like way above average growth, and my gut tells me it's going to slow down a bit. But I've got nothing to support that, so it's
Well,
purely
the
gut
alt
feel.
data, yeah, the alt data apparently supports that this year. Another thing, the thing I think I'm the most concerned about is the lack of international growth. Now it's early. They've really only done their push internationally in a meaningful way over the last year, but I would hope that that would start growing at 100% if why can't this work in Australia, United Kingdom, Canada, which is their first markets, just as it has in the United States? And if it hasn't, well, then that would be a big concern for me because one of the key reasons for Monster Red Bull's success is the international distribution and why they're replacing soft drinks in that part of the world. Let's see if we have any comments here. It says Celsius drink. Yeah, you had that one. Celsius has to be addictive, like Coke or Pepsi or Zyn and smokes, in order to have the true conviction in the investment. Because I've never had a Celsius. I know it has caffeine, but maybe that specific taste people, can't replicate. There is that type of discussions. I mean, I've been looking around at the Zyn shortage stuff, and people talk about how each different pouch for the nicotine pouches has a different feel, and it has a different there are these unique things that people have. I mean, with the Coke versus Pepsi stuff, there's that slight difference in taste, but it really matters for people that have built up that habit over a long time. We have James Goodwin saying, I always choose Red Bull because of the can size over Monster. It does make sense. I guess it does matter out there. Uh, and it's also the size of the caffeine there. I think that's it, though, for that topic, Ryan. Unless you have anything else on Celsius, we can move on to another question.
Yeah, let's do the small cap of the week if you're
First, you
happy
want to talk
jump.
about our friends at FinChat with those charts?
Yeah, sure. We already mentioned it. We've shared FinChat charts all day today if you're watching on video. If you haven't, FinChat, for those that don't know, fundamental research terminal. It's a way to just look up stocks and get really comprehensive financials as well as segments and KPIs, and it tracks really the data that matters. I work there, so I'm extremely biased, but I wouldn't be working there if I didn't really love the platform. So I recommend checking it out. It's finchat.io/chitchat. Gets you 15% off any paid plans. Also, if you sign up, you get the first 2 weeks free. If you are on the fence about whether or not you want a research terminal, let me just tell you, I was one of those guys that thought I can do all this in Google Sheets or Excel myself. I don't need that. And it is a massive time saver. So highly recommend at least checking it out. But do we want to talk about our small cap of the week?
Definitely. Looks like we got, let me tease you up here, Hammond Manufacturing Company Limited. Now, what is this, Ryan?
Yeah, maybe not the sexiest name in the world, but I guess I came across this by reading the annual letter from a small cap investor that I really like. I think the name is Smoke Capital. And he does a lot of good write-ups on really undiscovered stocks. So this was one of them that he wrote up in his latest annual letter. He says Hammond Manufacturing makes electrical enclosures, racks and cabinets, power distribution products, transformers, and many related accessories for a variety of industries. I know that sounds pretty exciting. So I can see Brett getting excited there. These may sound like boring products, but due to secular trends in cloud computing, infrastructure investment, and electrification of everything, Hammond has experienced steady, profitable growth for many years. And that is the case. If you pull up, Brett, maybe if you pull up the chart here, I'll say that there are two different companies, and this is Canadian. This is a Canadian company. There's one that's Hammond something or other. I can't remember the other one, but this is HMM.A if you want to type that in.
You want the chart from the show notes or what?
Either one. If you just share the screen, you can see revenue has grown at about 9% annually over the last decade. So gone from about $105 million in revenue to $235 million in revenue. And earnings per share has grown by roughly 20% a year for a decade. So impressive financial growth. And usually for a small cap, you don't see this level of like consistency. It's typically like a little more lumpy, but it seems like it's been good results for Hammond. The total market cap of Hammond Manufacturing is 108 million Canadian, which I think comes out to like probably like 80 million USD would be my guess. Just kind of mental math there. Last 12 months though, this is all in Canadian, by the way. So just kind of, I don't know, convert it if you want, if you're interested in looking a little deeper. It says last 12 months, $235 million in revenue, Canadian. And keep in mind, $100 million market cap, roughly. $28 million in operating income with $35 million of net debt on the balance sheet. So EV to EBIT of roughly 5 times for a company that has grown earnings per share at about 20% a year for a decade. There's another quote from the letter. He says they own over 500,000 square feet of manufacturing facilities located only 1 to 1.5 hours from the Toronto metro area. Since the company was founded over 100 years ago, and most of this is carried at cost, the value of their manufacturing facilities alone likely comes close to, if not exceeds, the current market cap of 100 million Canadian. So obviously, that's probably not going to be monetized as long as the company wants to continue operating, but it's a little bit of margin of safety there, knowing that they've got this real estate value in the event that there was ever a liquidation. But in the meantime, it seems like you got a business where there's been some real tailwinds. Management doesn't really seem that keen on like big public investment disclosures, like getting more and more investors. They're not much of like a hype up management team, but the results have been there. They've got some tailwinds. The total returns over the last decade have amounted to a 22% CAGR. So real returns here, good valuation. I don't know. It feels like there's a lot to like. This might be the most exciting one I've looked at so far.
Yeah, definitely. There's a lot to like here. As always, there's a few questions that we'd have to answer, and the ones that come to mind first for me. I know you mentioned that it is a secular grower, and you said it may sound boring, but products, there's cloud computing infrastructure investment, electrification of everything that's helping with their products. But what I see on this chart here is earnings from 2021 to today went on a huge boost. So I wonder if that's one, inflation, right? Or two, some sort of COVID bullwhip. And that's something I would be concerned about, whether the normalized earnings are slightly lower. And maybe that doesn't matter since it's at 5 times earnings. And then second is the cash flow conversion. I'm seeing on the chart here that it's okay. I have a chart here on FinChat. Actually, I'll just share it so that people can watching on YouTube can see it. But essentially, it's showing that free cash flow has lagged a little bit here. Let me pull it up.
Yeah, I would imagine this is, especially as of late, kind of an inventory heavy business.
Yeah, so that's it's not the end of the world, but it's something to be concerned about. So we have operating income over the last 12 months, 28 million, but free cash flow of only 14.7 million. That's the blue chart. It's the free cash flow. Orange is the operating income, and it looks like I'm trying to track here. Almost every year, free cash flow has been lower. Now it's been positive most years, but I think that is a concern for me. It does matter at the end of the day that it's not like the unit economics of the business matter a lot more, but the free cash flow conversion is a factor, and that would probably impact my valuation work. What about their capital
Yeah,
return strategy?
I didn't
Anything
really,
on that?
I didn't look into it too much, but I'll say with any sort of industrial type of business where they're selling whatever gizmos, gadgets, and it's growing, you're going to have inventory growth, hopefully in line with kind of revenues. You don't want like insane inventory growth that's like outpacing sales, but that's going to lead to a cash flow lag. That's a part of the model. And as long as it's a business that continues to grow, what are we looking at here? Shares outstanding.
Yeah, very insightful chart here, Ryan. Shares outstanding have not gone anywhere. Maybe they're inspired by old Constellation software. 11.3 million in 2014, 11.3 million over the last 12 months. So
You know
I
what? I
guess
kind of
that's
like that.
hey, it's better than a 2% growth, which a lot of US companies have.
I actually, Nick Sleep in one of his letters he said that was something he did. He did a screener for companies that had exactly 0% shares outstanding growth. Because if it
I
was
guess
because if
that's
a
durability.
business generated good returns and it wasn't moving its shares outstanding at all, you knew there was some power in the business. So, um, yeah, you really have to assume that the growth continues for this business, because if it doesn't, then you get a whole bunch of inventory that you no longer need. If it continues to grow, I think it's okay to see the cash flow lag. You just got to believe in the durability here.
Yeah.
It's definitely one that I worry maybe a little bit about cyclicality. So I'll probably have to do a little more digging. The other thing that was interesting is their little, I don't know if it's like a sister company, how it works, but there's another Hammond based company that operates similarly to Hammond Manufacturing Limited, and it trades at like twice the multiple. So, and the growth hasn't been that much better. So I'm curious what the why there's the big discrepancy.
I would investigate that as well. I guess there's probably some history. Usually when there's two companies with the same name, it's probably a family business that got split up a while ago or something related to that. When something has the name Hammond, it's usually the same family, I would guess. But any Canadian listeners, let us know on that one. I know we have a good chunk from Canada. Maybe like 7% of the listeners are from up north. So hit us up if you know anything about Hammond, although it's a tiny company.
All right, before we move on, earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Thank you to Public. Hey, I got something related to options here. This is a screenshot from someone named Nikita Beer, Bier, is their name on Twitter. Says, some person bought Rivian calls this morning that expire on Friday for 12 cents each, and they're now worth $5.30. He made $2 million in 5 hours. Now,
Hello,
congratulations to the SEC. This
SEC.
is the
Yeah.
easiest crime to solve ever. Good luck with that one. Good luck trying to make someone's getting a huge. I can't wait for that. I subscribe to the SEC newsletter for enforcement actions, which can be it's free. It's kind of nice. You can see if any of the ones getting any fines. This one's going to be easy. It's guaranteed insider trading.
Yeah. I don't want to give insider trading advice, but if I were, my advice would be if you have material information that you know is going to move the stock and you want to profit off of it without getting caught, buying extremely out of the money options that expire in a short duration is the number one way to get caught. I highly recommend not doing that. Maybe just buy the stock, because that could happen at any point and it's a little harder to track. I know you're not going to get quite the same profits. And if you think, oh, well, I tipped off a friend, they can draw they can draw the lines. They can connect the dots. So I just, maybe don't buy out of the money options in a
Don't
week.
buy that many. Like, you can't be in a huge change in what the volume is. Like, they're going to track that irregularities. All you have to do is some sort of algorithmic tracking thing to see for any irregularities in the trading. We have a question here. I think this is an interesting one. Have you guys been following Embracer Group since you had the CEO on a couple years back? No hate, but what an example of 2020 insanity. Yeah, it's one we didn't own. We were a little bit concerned because it was just listed in that European market they were in. The guy was a nice guy, seemed really sharp, but from what it seems like it happened, they just got a little too aggressive, and now they're trying to claw things back as the video game industry really hit a tough spot over the last few years, and that combination was tough for them.
Yeah, I hate to say it, but it's a little bit of a yellow flag if you come on our podcast at this point. It seems like for executives, as much as I want executives to come on our show, it hasn't ended up quite that well for a lot of the securities following joining our show. Hopefully that's just coincidence. But that was it. I don't follow Embracer Group that closely. To be honest, I've soured a little bit on video games relative to what I thought kind of 2 to 3 years ago, especially with some of the larger publishers, Take-Two and EA. Embracer Group, maybe now's the time to look and kind of
guess do you want to guess what drawdown they're in?
80%.
That is right, 83%.
Nice.
Let's look at the old. I know this is in Swedish krona, so sometimes you have to do a little bit of investigation to make sure the multiples are correct. Price to gross profit, Ryan? I know it's not a real metric. Doesn't matter. You can't eat gross profit, but it's below 1.
That's
Hey,
what I'm saying. Maybe now's the time to look. The I'd have to revisit the catalog because with a business like this, the last thing I would want is like a bunch of one-time hits. Like if
no
there's
stability. Yeah.
yeah, if there's a whole bunch of games in there that like had some success, but you have to bet on like repeat success and there's no like durability of the brands, then I'd be a little worried. But if you've got some durable brands, and I don't even remember what was in there, but if you've got some durable brands, could certainly be worth it.
Yep.
Even if it's the difficulty is that the operating expenses for developing a game are quite high. So the gross profit might be slightly misleading in terms of what the company could truly earn.
I
So
agree.
I'd be curious what kind of cash flow margins they could actually generate. I do remember Lars kind of roasted me and he's like, I was like, so what do you look for when you're acquiring a company? He's like, I try to make money. That
Yeah.
makes sense.
Well, that hasn't worked
Good for
out
you.
so far. Maybe this is the one that I should research next. I know we just did Molson Coors, or I did Molson Coors for my stock research episode. Maybe this one, a little revisit could be fun. Might be potentially cheap. And I think they've always talked about listing in the US. I think they probably have done that now. But we're hitting the last part of the episode here. Ryan, anything else?
I got a question for you. Mount Rushmore of management teams that frustrate you the most.
Like a type?
Nope. Specific
Just
ones.
just specific ones? Well, Block, Autodesk. Hard to think of everything that comes to mind. Probably not Spotify, although they were for a little bit back in 2021, 2022. But I think they've learned their lesson. They've shown a little bit of aptitude to learning from shareholders. Those two come to mind. Autodesk, Electronic Arts a little bit,
EA. Yeah, they're up for
because they say the same thing every quarter and they don't really grow. And they're like, oh, well, we're investing in this and we're going to grow 5%, blah, 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 blah. But nothing ever changes. So they become a bit of a boy who cried wolf.
Yeah. It's funny how you don't when you read conference calls in and out quarter after quarter for EA, you get the sense that they're growing.
But they're
Like,
not. Yeah.
but then you look back at the financials and they aren't growing. And it's like, how? And it's because they're constantly changing the metric that they talk about for growth. Like, okay, live services grew, mobile grew, bookings specifically grew, or revenue specifically grew, whichever one kind of paints them in the best light. And then you just look back and it's been this stagnant business for quite a while. Yeah, that frustrates me. Anyone where the CEO has been taking quite a huge chunk of compensation and the true underlying growth of the business hasn't been great, that's a frustrating situation. Autodesk and EA are definitely up there for me.
All right. We need one more for the Mount Rushmore. We have EA, Autodesk, and what did I say? Oh, Block. I mean, come on. Dorsey. Maybe he doesn't frustrate me because he's kind of an enigma. He's fun to follow, but
Oh gosh, if you were a shareholder, you'd hate him.
yeah, exactly.
But
Exactly.
yeah, he's entertaining for the sole purpose of like he doesn't seem to care what any shareholders think. And so like from
Yeah.
the outside looking in, it's kind of funny. Salesforce, sure. Yeah, Benioff. I said it a couple podcasts ago, walking red flag. The other
Salesforce has
executive
got to
team.
be there for me because the stock's done well, but the management still frustrates you. It's not necessarily about the ones that I wouldn't invest in, but Salesforce, like, they're so frustrating.
I'd say Axon's that way too. Great
Ooh,
business model, great
good.
stock performance, but man, something about that management team kind of irks me. I think it was
The
probably a lot of the
exponential stock
lies.
plan. Yeah, remember that one.
Yeah. Yeah. They finally remedied that, but there was some
Okay,
issues there.
I got a fun final topic for you. I tweeted this out and got a lot of comments, so I always do that as my, you know, that's the criterion for whether it's a fun topic for the episode. So this was my take, lukewarm take, not something I'm like I have a hard opinion on. Here it is. A dividend plus share repurchase combo is almost always better than only using one capital return strategy. Do you agree or disagree, Ryan? I think we've talked about this off air too.
Yeah, I probably agree. I remember kind of when I started investing, I used to be some share repurchase truther that like in the long run, share repurchases are better. And if you're a long-term investor, that's all that matters. But it's easier to pull back on a share repurchase authorization than it is on a dividend. Like if you're constantly paying out a dividend, you get a lot of shareholders that like dividends. And if you turn that off, it's going to hurt the stock price. Whereas if you don't buy quite as much stock in a quarter, people might not notice. Um, so I like having at least some level of a dividend where it forces you to return capital to shareholders. And then the buyback, yeah, having it as an open authorization allows you to really turn on the capital return strategy when things get rough. So yeah, I agree. Probably some balance of the two is probably best. And I think we're even seeing that now with companies that have historically been huge dividend payers. You see it with some of the tobacco companies. They're starting to sprinkle in some buybacks as well. And if they have the cash to do it, I like that strategy.
Yeah, what I th- so couple things. Let me organize my thoughts in my head here. People always have the classic thing, and it's right that dividends are not as tax effective. Especially, you get that 20% tax rate that matters, but two things I think help with paying a dividend along with repurchasing stock. One, if you're a buy and hold, never sell, hold a company for the long-term investor, if it never pays out a dividend, you have to make some sell decisions eventually in order to realize gains. But if they pay a growing dividend, that makes it so you don't have to have a tough decision of, okay, when do I time to sell? No, they're going to give me some cash, a growing amount of cash every quarter or every year, however they pay it out. Um, and then the second thing is, if you are, for example, these tobacco companies, if you are they're even declining your share count by 2-3% a year, you don't have to grow your free cash flow that much, and you can continue to grow that dividend per share payout. And I think it's a much healthier situation for everyone. One, your stock doesn't stay in the gutter, even though your total return might be okay. People do get upset about that. I think it's a much better symbiotic relationship to have that combination, even if it's 80% buyback, 20% dividend. You can grow that dividend per share at a pretty aggressive rate if you're reducing that share count and vice versa. Where someone like, say, Netflix, who hasn't started paying a dividend, they're just buying back stock. I would like them to do the combination because they're in more of their profit mode right now. They're done with the huge investment, the reinvestment that they've done for many years. This will help. Like if they started paying a nominal dividend, that can really help for your long term shareholders that have been with you, and it's turned into a hunter bagger. But how do you make that sell decision? People are usually bad at making sell decisions. I think that dividend payout, it kind of, I almost think about it like a pressure valve building up, and then the dividend per share that they pay and hopefully grow each year can be some release of that pressure and make it much less stressful for the long term shareholders. Because for me, I would just like them to pay out the dividends, and I don't have to make any more decisions after I buy, as long as the business is still performing well.
Yeah, the other thing is a dividend just makes it a little easier to model
It's true.
because you're like, okay, here's the cash I could get, and they are giving it to me. Whereas a share repurchase, you really got to get to know management, because if you think they're going to like say, here's what we could give you, whoops, we made an acquisition with that money instead, uh, it makes it quite frustrating as a shareholder. So I do, yeah, maybe I'm just becoming like a boomer or something, but I feel myself growing more and more into the dividend camp. Like, yes,
Here,
give me the money now.
here's some good examples. Apple, for combos. Apple, American Express, Texas Instruments. Those have been some really strong performers. Someone says here, Hilton says, or I think that's his name. Yeah, says the problem with buybacks is that the company, for the most part, has to be misunderstood or in a disliked industry in order to be truly value creating. I think, yeah, the buybacks can be so helpful in a perfect situation, but there has to be a few factors that come into play where if you're Yeah, where the buyback, where a sold buyback can be such, a huge value creation if you have durable earnings and you're trading at a below 10 times free cash flow, something like that. But that's not for everyone. And it doesn't happen that much. And the management team has to be good, right? Where a dividend, if you just say, we're going to pay a dividend, we're also going to consistently buy back some stock, but then that's going to allow us through our earnings growth and the share count coming down, we can grow our dividend by 3, 4, 5% a year. That's very simple for management teams to understand. And usually that's better than, oh, we're going to be great capital allocators and, repurchase at the lows.
Yeah, I think it's funny when people see, okay, a company initiated a dividend. Well, that's the beginning of the end. Like there it speaks to like the robustness ratio element that we study with Nick Sleep, where it's at a certain stage of a company's life cycle, after a certain point, you can still reward employees and reward customers with whatever, returning some of the cost advantages that you've got getting to the size you have, while returning capital to shareholders. There's just more capital to go around, and you can still grow in the process. So no, it is not the beginning of the end when a company initiates a dividend. In fact, I would love to see some studies on that and see what the growth rates have been post dividend initiation, because my guess is that companies still grow pretty quickly even after the dividend has been initiated.
Yep, we have some comments here as we're trying to wrap up. Dividends keep them honest. Makes sense. Fan of dividends only because most CEOs are not good allocators. In a magic world where I have a good allocator, give me the buyback all day. Problem is hard to find and hard to know in advance. I've come to distrust acquisitions so much it's almost a sell signal for me when a large one is announced, unless there's a very solid case or track record preceding it. I think both those make sense. And usually when you have a dividend getting paid out and you have a policy of we're going to try to grow it and use, say, 70% of our earnings or something like that to fuel it, well, that can keep the management in line. Yeah, you might not get the optimized returns and the taxes aren't as good, but you'd rather have that than make a giant mistake and blow up. All right.
Yeah.
Anything else, Ryan?
If Buffett is the one allocating capital, I think I'd rather him do it than having myself do it, which that is really the dividend. Like a dividend is more or less who gets to allocate the capital. And
Hot take, Ryan. Berkshire should have a dividend.
no. You think?
Yeah.
You don't think Buffett can generate above better
He's
returns than you?
All respect to the GOAT, he's about to pass away within the decade. So they need to have. They should be. Yeah.
So
This is a great example of how the pressure valve of expectations are so high, and they should. Yeah.
So do you think you can generate a better return with the dividend paid out to you than Ajit Jain can generate finding a new insurance deal?
No, I think that's a separate question because the company's too big now. They don't need the cash. Give it back to their shareholders. There's nothing that's going to prevent giving $100 billion in cash back or whatever it would be over a multi-year period is not going to impact their ability to do anything.
Yeah, maybe at this size, I could agree with it. But when people were clamoring for dividends in the early 90s or the late 90s, as I remember it from the shareholder meetings, I think I'd rather have Buffett with that money.
Yeah, but he is a 93 now, Ryan.
He's hitting his prime. He's just hitting his stride.
He's
Japan deal? Oh, it was a once in a lifetime investment. He nailed it.
No, special dividend. Let's do it. Maybe that could be another. That's a hot take video that I think could do quite well. Maybe we could do that as a separate one. But thank you everyone for listening. We're gonna close things out here. I know we're a little over an hour. Apologies for the time change. We will try to be as consistent as possible, but sometimes we got to change it up and do different times depending on our schedules. So we usually try to do this about 9:30 a.m. Pacific time, 10:30 a.m. Pacific time, something along that on Thursdays. But today we had to do it one day early on Wednesday. And next week, given the 4th of July, Independence Day for the United States, we're going to be doing it on a Wednesday as well. Either way, though, you can listen to the replays on your podcast player of choice that comes out every Sunday, or watch the replay on YouTube. You don't have to join us live, but the only thing is you can come on live and ask us any questions, and we'll do any sort of topics. We love the audience that joins us and asks some fantastic questions, gives us some ideas, and helps us research, as I mentioned, as the hive mind sometimes for some of these small cap stocks. But let me hit the disclosure. We are not financial advisors. Anything on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, again for tuning in, and we'll see you next week.